Hey everyone, it's Wolfgang. I want to talk about the market crash that's happening today. It's March 10th, 2025. We're getting close to a 10% correction in the overall market, the stock market. Today alone, the Dow Jones Industrial Average dropped 1,070 points at one point, 2.5% drop in one day. That's pretty wild. The Nasdaq dropped at one point during the day today, 845 points. That's almost 5% down in one day. That is really wild. That's quite a drop. So the market will not bounce back immediately. It's not going to recover quickly. There is uncertainty in the economy. There's a lot of different reasons for that. But in general, when a person feels uncertain, they hesitate, right? If you're in a situation somewhere and you feel uncertain, maybe it's a survival instinct that you reduce the amount of activity just to be able to assess what's going on and see what the situation actually is. Is there a risk? Can I reduce the risk by taking no action? So people hesitate when there's uncertainty. Businesses sort of act the same way. They will pause their activity. They will pause hiring when there's uncertainty. Right now, when the market is down nearly 10%, people feel uncertain and businesses feel uncertain. So you can expect a reduction of activity. Some people who own stock assets, they have sort of a hair trigger to sell if they notice the market is dropping. When the market is down, approaching 10%, more and more people decide to sell their stock assets. That's a mistake, and I'll explain why as we go through here. It's a mistake to sell, but that's what people do. Some people do not sell. People who generally are in the market for a long time, long-term hold of stock assets tend not to sell. Reason being, they did not buy stock assets with the intent to see them go up right away so they can sell them and make some money. Generally, long-term investors, they know that the stock market returns about 10% a year over the long term. So the people who do not sell know that. So when they enter into the stock market, when they buy stock assets, they don't plan on selling just because the market has a down day. 10% you can say is quite a bit down, but traders, people who trade in and out of stock assets frequently, their situation's a little bit different from a long-term investor. Traders, in order to trade, they need their money. They need cash to be able to place trades, to buy and sell stocks. So when a downturn like this happens, a lot of traders will just sell, and that drives prices down even more. When a lot of people are selling, it's the supply and demand issue. When the supply of stocks goes up, the demand drops, so the price drops too. So that's kind of what's going on right now. There's a lot of people selling, people who had a short-term investment horizon. Traders are not really investors. Traders are trying to time the market. They have trading strategies. I've used those in my past. I have a trading history. I'm going to go into that, what I was doing. So I've got experience in both of these, long-term investment in stock assets and trading. I've got pretty substantial experience in both of those activities. They're quite a bit different. And I'll explain what the differences are for traders. For long-term investors, you're basically choosing companies that you think are good companies and that over time will do well, or you're buying ETFs, you're buying a broader market exchange-traded fund, which is a collection of stocks in an area that you think will improve over time, like tech stocks, tech stock ETFs, or ETFs that are heavily weighted towards technology, for example. A lot of people think the technology will keep improving over time, and it generally does. Technology, it reinvents itself over and over and over throughout the year. So generally, technology does well. But in the stock market overall, over long periods of time, returns 10%. Traders don't care about that. They want to get into the market at a good point and then sell and make a profit right away. So let's think about where you might invest $100,000 now. If you had $100,000 to invest, and by the way, this is not investing advice. If you do invest in the market, you should rely on investment professionals. You should not take any advice from me because I'm not doing this. Truth be told, I'm not taking the action. I'm not trying. I'm just saying theoretically, if you had $100,000 to invest, how might you go about it to protect yourself? If you wanted to make a safe investment when the market is down this much, could you do it? And then if you could, how would you do it? So that's what I want to discuss here. So one thing to think about would be a broad market exchange traded fund. The S&P 500 is the broad market, and an exchange traded fund that collects a bunch of S&P 500 stocks into it, the S&P 500 index stocks. That might be something you would consider when we're approaching a 10% correction. Now, if you contrast that to when the market was at the very top just a short time ago, had you bought the S&P 500 ETF, you would have seen a drawdown, a drop in the price of the ETF that you really don't lose money unless you actually sell it. You still have your investment. But the point I'm making here is if there's a 10% correction now, this is a much better time to deploy 100,000, to invest 100,000 compared to just a short time ago. If you were to buy the broad market exchange traded fund, the S&P 500, not a bad idea, because over time, and again, this is assuming you're doing it for a long-term hold. For me, long-term is 10 years minimum. Most of the, my personal portfolio, I've got stuff in there that I've held for over 2 decades. So I like long-term investing. It has worked out pretty well. So that's one option. If you had 100K to invest now after the drawdown, after the drop in the market, an S&P 500 exchange traded fund. Another option would be the exchange traded fund called QQQ. That is sort of a technology exchange traded fund. If you know something about technology, if you're a fan of technology, this is a bit more narrow than the broad market S&P 500. But if we've just had a drop in the market of near 10% and you want to put 100,000 to work and you like tech, that could be an option, the QQQ. Another option would be bonds. Bonds is pretty darn safe, right? So U.S. Treasury bonds in particular. You can buy U.S. Treasuries if you go online to treasurydirect.com. You can get a lot of information about upcoming U.S. Treasury auctions. You can there is the possibility to buy Treasury bonds on the secondary market or buy them at auction. There's a couple of different alternatives there. U.S. Treasury bonds are very safe, and generally you would want to divide the 100,000 among different assets. You wouldn't want to put it all in one place. So, and certainly, at least in my opinion, you would not want to put all that money into one stock. I definitely do not recommend that. So money is made by making purchases after a crash. That's the reason I wanted to make this video. We're getting close to a 10% correction. And if you were to put money to work, this would be a great time because the correction has occurred. That being said, I want to be clear about my personal instinct and gut feeling about the market. I suspect we have a ways to go down. I don't think this is the end of the downturn. I think we have a lot more, a fair amount, a moderate amount to maybe a lot more selling that's going to happen. And when there's a lot of selling, the market drops further. So if I were to make an investment decision about 100,000 today, I would say I'm not putting that money to work today because I think my gut feeling is we're going to see a continued downward trend in stock prices. You could put the money to work in bonds, right? But it might be a good time to pause. If there's uncertainty, we don't know which direction the market's going to move. It's not a bad idea to hesitate. Be patient and wait for things to clearly indicate what direction they're going. As an example, one way that people make the decision to get back into the market is they wait until the market has been down for a while and people are unhappy with stocks, and then the market starts creeping back up. That can be a good time to buy. When everybody's fed up with stocks and the market starts to creep back up, that might be a good time to get to invest. But if you were to invest 100K now, that's what you would want to consider: the S&P 500 for the broad market, a tech exchange traded fund, the QQQ, bonds, and you'd want to divide the 100,000 among different assets. And you should definitely hold for the long term. That's just my opinion, 10 years at least. And money is made by making purchases after a crash, as I pointed out. This is sort of post-crash. We're getting into post-crash territory now. We still have a ways to go before the selling stops, in my opinion. But in general, if you were to buy somewhere in this time frame, now or in the near future, and you held for 10 years, you'd probably be in pretty good shape as long as you buy the broad market or a pretty broad basket of tech stocks. Not just one company, not one not one stock issue. I don't recommend buying just one company's stock. I've done that, and I don't recommend it. So here's an example. The SPY ETF. This is an S&P 500 exchange traded fund. SPY is the ticker symbol. If you look that up on your online brokerage, it's the S&P 500 broad market. Back at the end of December of 2022, the market fell and Amazon stock fell and the SPY fell. There was a lot of selling at the end of December of 2022. If you had bought SPY at the end of December 2022, you would be sitting on a 148% gain. Why? Because that was at the bottom. That was after the market had corrected. You waited until things had dropped and then you buy. Because once people have sold and once the selling stops and the market starts to tick back up, you can make these kind of returns. 148% in less than 3 years, from the end of December to now is 2 years and not quite 3 months. That's a fantastic return, 148%. And that's a pretty darn safe asset. The SPY is the broad market. You'd be sitting on a 148% return again on the SPY. If you had waited, if you had said, okay, I've got some dry powder in my account, I've got some cash in my account. Most of us from time to time have some dry powder, some cash sitting in the account, the stock account. And you say, oh, the market's crashed. We're getting to a point where it might be a good time to get off the buy list. Everybody has, well, not everybody, but you should have a buy list of things you'd like to buy if the whole stock market tanked. By the way, I want to say something about when the market corrects. When the market corrects, it takes down the crummy stocks, but it takes down the good stocks too. When the whole market corrects, it's like a bathtub being drained. Everything floats downward. So even the good stuff starts to drop in value. So generally, if you have some dry powder in your account and you have a buy list, if you make a list of assets you'd like to buy, if only the market would correct 10%. And so this can be a time where you look at, we're getting close to 10%. You look at your buy list and you say, I'm going to buy a certain amount of this. I'm going to buy the QQQ. I'm going to buy the SPY. If you had done that at the end of December, you're sitting on 148% return. Now, if you were a little bit crazy, because I think people who buy individual stocks are a little bit crazy. That's just me. I don't recommend it. I don't do that. I've done it in the past. When I was trading, I did it almost exclusively. I bought single stocks when I was trading. I don't recommend this anyway. But that being said, when the market at the end of December 2022 fell and the SPY fell and Amazon fell, if you had bought Amazon at that time, you'd be sitting on a 230% return right now on Amazon stock. And people say, well, Amazon's a great company. It can be a good idea to buy great companies when the whole market crashes. I disagree because it's a single stock. You're pinning too many hopes on one company's ability to execute after a downturn. And that's why I stick with the S&P 500 or the QQQ ETF. I'm a long-term investor. I recommend everyone be a long-term investor. Long-term for me is 10 years. The stock market returns 10%, 10% a year. I wrote it here somewhere. The market returns 10% a year on average. So basically, you could buy individual stocks every once in a while if you keep an eye on them and you limit the amount you invest in them. So let me just tell you briefly what my trading was like. I started trading. I had a very healthy income. I was working in Silicon Valley. I was trading heavily. And I better, I want to consult my notes here. I was trading frequently. I had a healthy income. I learned and applied different trading systems. And here's what happened to me when I was trading. I got fed up with 3 issues. Some of my trading strategies were extremely effective. And I mean extremely effective. They were working great. And then all of a sudden, I started noticing that it sort of felt like someone was looking over my shoulder and front-running my trades because I was trading a fair amount of... and so I don't know, I can't prove that, but just all of a sudden, the trading strategy seemed to stop working. And I thought to myself, because I'm a software engineer and I know darn well how online trading companies work, online brokerage accounts, if someone wanted to, it would be very easy to write a piece of software that would look at everyone's stock accounts and then to create a report every day or every hour on the most successful accounts in the brokerage and then figure out what that trading strategy is and copy it. That would be a very easy program to write. It would probably take under an hour to, if you're working at an online brokerage, you could say, I'm going to write a program that looks at every all of our customers' accounts. I'm going to group all of the most successful accounts in the top 1% of all of our accounts. And for those, I'm going to look and see what their trades have been, and I'm going to copy that strategy. So it would be very easy for an online brokerage company, and it would be an employee, sort of a rogue. I don't think the online brokerage would do it themselves, but I think a rogue employee might, especially if they could write a program like that, if they had a software background. So one of the things that I started noticing my most successful trading strategies, it seemed like somebody was front running my trades. And so they kind of stopped working. Another thing I noticed, the online brokerages that I was using kept making mistakes in my account, and I kept having to call them to correct the mistakes. And the third thing is, and this was a biggie, the tax issue when you're trading a lot. When you're trading frequently and you're selling, you have to report short-term gains. And when you trade a lot, the amount of bookkeeping you have to do to keep track of all your trades, to report those to the IRS, is a burden. It becomes a burden. And so those three things kind of did me in, because I came to realize it doesn't matter what my trading strategy is. At some point, it's going to stop working. And I'm tired of the online brokerages making mistakes that I have to call and correct. And I'm fed up with the tax reporting. So I'm going to buy and hold long term. I'm going to take advantage of the market returning 10%, which it does over the long term. So that is my advice. That's kind of why I said through this, I would recommend a long-term investing approach. If you're kind of bummed out about this correction we're having today, Charlie Munger said, Charlie Munger, the partner of Warren Buffett in Berkshire Hathaway, he said, if you cannot stomach the stock market dropping 50% from time to time, you probably should not be in the stock market. And I've seen some pretty gnarly crashes. I happen to have some dry powder, and I'm probably going to be, I do have a buy list. I've got a list of things I'd like to buy. If only we'd have a huge correction, right? And we're getting close to that. So it's getting tempting. There are some things I would like to buy, and I'm probably going to act on those. But I think we have a ways to go on the downside. If you have any questions about this, I'd be happy to answer. I've got experience as an investor. Most of my most recent experience for the last quite a while now has been as an investor who holds things when the market reverses. I don't like buying options to protect my holds. I don't like selling covered calls. I've done all that stuff. I like to buy good assets and hold them for the long term. And so we're getting close to a good time to buy some stuff. So I don't recommend single stock purchases. You can get lucky if it's a good company and the company can execute after the downturn, but you never know. And it's not worth, 100,000 is a fair chunk of cash. You'd hate to put that on one stock only to lose half of it and then have to wait forever for it to recover if it ever does. So if you have any questions about this, I'd be happy to answer your questions. And fear not, because the market always recovers. Over time, if you look at any chart of the overall broad market, the S&P 500, the Dow Jones, over the very long term, the market has ups and downs, but it's generally trending upward. 10% return over the long term, that's what I recommend. So I'd be happy to answer any questions you can post in the comments, and I want to thank everyone for watching, and have a great day.